Good morning. This is Jonathan Gephart with 643 Insurance, and with me today I have Rob Young with Blue Dot Wealth Management. And today we're going to discuss financial planning and how insurance and a financial planner, of course, tie into a good financial plan. And so before we get into each of the pieces of what Rob and I both do, just want to name the pieces of a financial plan. So the pieces of a financial plan is going to be insurance. You've got investments, retirement strategy, estate planning, and taxes. And so today we're going to talk about, of course, the insurance piece of it, investments, and the retirement strategy. And so, Rob, can you do me a favor and just tell us a little bit about what you do as a financial planner?
Yeah, thank you very much for having me, Jonathan. I really appreciate it. A lot of when a lot of times I think when people think about financial planners or people in our profession, sometimes they think about like movies like Wall Street or that kind of stuff, and that's like the furthest thing from really what we do. Most of what we do is spend a lot of time talking with our clients about what is important to them, and then help them structure a plan, whether that's a short-term, medium-term, or long-term plan. And sometimes it's all three, oftentimes it's all three, so that we can get them to the goals that they're looking to accomplish, whether that is sending their kids to college or retiring or buying a vacation home or any other number of things that they're interested in accomplishing that has something to do with finances. We tend to touch all of those things.
Okay. And from your experience, what is a good age to really start thinking about financial planning?
So the younger, the better. I think everyone would probably like to start younger. If you ask a 50-year or a 60-year-old person when they wish they had started, they would tell you, when I got my first job, or right after college, or right after high school, or fill in the blank, right? I don't think one is never too young to start. But the flip side of that is one is never too old to start either, right? It's so much easier to have a plan going forward, even if you're in your 50s or 60s or what have you, and you think you're starting too late. Getting started, period, is better than never starting at all.
Okay, awesome. Thank you for that. So I'm going to go into the insurance piece of financial planning and the importance of having proper insurance coverage. It's really important to make sure you protect your assets. Accumulating wealth is the goal, right? We want to make sure we have enough assets in order to provide for now, but we'll also to provide for the future, retirement, and even maybe a legacy, passing on our wealth to our kids. And so, with insurance, there's a lot of different pieces to that. So we're going to have, of course, the personal lines insurance, which is home and auto insurance, golf carts, motorcycle, all of those types of insurance policies. Then we've got life insurance, health insurance, and long-term care. And so all those pieces of insurance are really meant to protect your current assets and also your future assets. We're talking about earnings, your income, things of that nature. And so, I see a lot of times as an insurance agent, a lot of people have state minimum coverages of 25,000 per person, 50,000 per occurrence, and like, well, okay, well that's all the state demands of me to carry, so that's all I'm going to do because it's going to be the cheapest option. But what they're forgetting is thinking long term about how that could affect them personally, their assets, and even their income, their future asset, their future earnings. And so, with having small liability coverages comes the risk of, if I cause an accident, I'm on the hook to having to cover all of those, the medical bills, the pain and suffering, all of the different things that come along with that accident, and which could very well be in the 50 to 100,000, hundred thousands of dollars of debt that would be incurred. And if I own a home, and if I have investments, and if I have, if I have a good paying job, they can not only use all of my insurance coverage, which we talked about, state minimum is 25,000 per person, 50,000 per occurrence. They can use all of that up, but then they can also put liens against my home. They can't take my home from me because of the Arizona Homestead Act, but they can put liens against any future, when I go to sell it, they can put liens against any sort of proceeds, any profits from that. And they can also garnish wages. If I'm making $50,000 to $100,000 a year and I'm in my 30s, I mean, you're talking about quite a bit of money of future assets that we're have to be taken into consideration, because it's my job as a someone who owns a vehicle and drives on the road. It's my job to protect and cover other people if I cause an accident, and so that's why it's really important to make sure to have. And I'm specifically talking about auto insurance, but the same thing can be said for home and all the other lines of insurance. It's really, really important to make sure that I'm covering and protecting my current assets and my future assets by carrying the right coverages in my insurance policies. And moving forward from that, life insurance is another piece of insurance that Rob and I both can speak about. And the purpose for life insurance policy is to make sure to take care of any sort of obligations now. And potentially there's a lot of different goals in life insurance, but a lot of people like it to use it to pass on a legacy, pass on future income, is another reason why people have life insurance. So for instance, if I pass away, my life insurance policy would take care of my mortgage. It'll take care of any sort of outstanding debt that I have right now, but it'll also set up my wife for, it'll give her at least 10 years of my earning, because when I die, my income goes away. And so want to provide my spouse with at least 10 years of income so that she can live life and not have to make any rash decisions in a horrible in that horrible time of her life. You really shouldn't be making those types of big decisions when you're grieving. And so, anything, Rob, that you'd like to add about life insurance?
No, I mean, you covered a lot of really good stuff there. From our perspective, we really do believe that defense wins championships, to, borrow a sports metaphor. If we don't have good defense set up for clients in the first place, it's really hard, to play offense in a very real way. So, we're very big believers in making sure that we are checking off those boxes, those needs, and having a really good idea of what a needs analysis is for clients, and that we're helping them essentially ensure that their loved ones are protected if there is a worst case scenario in all of that. It's one of the reasons why we really love working with you and referring clients to you, because we know that you take that same defense approach, and I can't stress how important we feel that is.
Absolutely. And I'm sure you and I, we've both come across people that we know, or we've seen people on social media where there's postings about GoFundMe accounts because a loved one has passed away. And the important thing is, just don't leave your family in the lurch. Don't leave them in a situation where now they have to cover, not only during the grieving process they have to grieve, but during that grieving process they have to cover all of these expenses that haven't been planned for. And so just really take the time, for the couple minutes, hours that it takes to put together a financial plan. Take that time to do that and set your loved ones up for financial success, in that, even though there is a hard time that they have to go through that grieving process, but at least they don't have to worry about the financial loss along with the loss of a loved one. We talked about insurance. Let's talk about the investments, and then we'll get into retirement strategy. So with investments, what does that mean?
Yeah, that's a great question. So, I think the way that we approach things, if we go back to like maybe high school or maybe even middle school, where we talked about Maslow's hierarchy of needs, at the bottom part of that pyramid, if you will, or that triangle, you have all of the things that we kind of talked about earlier, right? Life insurance, health insurance, disability insurance, car insurance, auto, home, all that kind of good stuff, right? Having that 3 to 6 months worth of savings, emergency fund, all of those things help us build a good, strong foundation. As we move up in the in order of things that we're really looking at when it comes to investments, we want to, and that middle part of the pyramid, we really view as what things can we help clients fund that give them some form of tax advantage, right? So that could be owning a home, right? You get a tax deduction if you have a mortgage for the mortgage interest. Homeownership is a hugely important part of not only somebody's individual financial plan, but the future wealth down the road as well. We want to look at what we call qualified accounts. So that could be your 401k if you have a company that is generous enough to have that kind of platform, or traditional IRAs, Roth IRAs. If you want to use college savings plans like 529 plans, anything that are kind of in that middle range, if you will. That's our big goal. When we get past that, what do we get tax deductions for stage? Then we get into all kinds of other investments, and that's a super broad term, right? We live in Arizona. There are plenty of people that love, real estate as an example, right? They want a vacation home, a rental property. Maybe they want to do Airbnbs or things along those lines. Those things are investments. And as a financial planner, we can help them model cash flow, do some cash flow analysis on their properties, all those other kinds of things. At our firm, we speak real estate, which is nice. We get into things like mutual funds and stocks and bonds and all kinds of exchange traded funds, which are the acronym for that is an ETF, exchange traded fund. All of those have different different structures, different tax consequences, different fees. And so, our role in all of that is to help really demystify as much of that as possible for clients, and give them some kind of structure and picture and philosophy on how to put those different pieces of the puzzle together so that they have something that's working for them and maybe not necessarily working against them. And that's a broad 30,000 foot level of that piece of things, I think. If I were to take a step back on retirement accounts, that middle section of the pyramid, if you will, we want to make sure that, clients are maximizing, their 401k plan. If they have a match in that 401k plan, we want to make sure that they're taking advantage of that as much as possible. We are big proponents of Roth IRAs. We have no idea what future tax rates are going to be. But when you do retire, we want clients to have a balanced approach to tax management in the future, right? And a Roth 401k or a Roth IRA can be big pieces of that particular part of a financial plan.
Great. Awesome. And as far as the retirement strategy, I'm sure there's a lot that goes into that. That's probably a pretty loaded question, but can you explain a little bit about retirement strategies? I'm sure that everybody differs in what they're looking to do with their retirement.
Yeah, that's to your point, it's an individual question, right? Like, I think there is some real benefit to the idea that if you set aside 10% of your income for savings for retirement, that is, that's a good amount. For some people, that is plenty, and for some people, it's not. And that kind of gets back to our earlier conversation about when to start, right? So if you're starting when you are in your 20s or even when you're in your teens, if you get your first, high school or post high school job, and you're putting money into that retirement account at a very, very young age, you need to save a whole lot less of your salary than you would if you were starting in your 50s or 60s or 40s or what have you, right? So, while it's a good rule of thumb, it may not necessarily be the right rule of thumb for everybody. And it's one of the reasons why we really do try to encourage, our clients to participate in their employer sponsor plans, those 401k plans, because that match, if it's 2, 3, 4, 5% or more, really does help go a long way toward helping people catch up, if you will, if they have started saving later in life. So, you know, I don't know. Like I said, a lot of what we do is individualized. You know, we want to make sure that we're giving advice to an individual, but again, as a starting point, 10% rule of thumb is a good rule of thumb.
Okay, great. And no matter where you are, like Rob said, no matter where you are in the process, if you haven't started saving, if you have started saving, but maybe you feel like you could do more, no matter what age you are, if you don't have somebody that you're working with to help you, first of all, if you don't know your goals, that's a good place to start. But if you don't have somebody to work with that you trust, or maybe you just don't ever hear back from them or things like that, I would highly recommend Rob Young with Blue Dot Wealth Management. He's my own personal advisor, and I know that he does a great job for us, and I know that he would do a great job for our clients or any viewers out there that are able to see this video. So is there anything else, Rob, that you'd like to add before we close?
When we think about financial planning, or if you're thinking about hiring a financial planner, I think there are some things to really, think about, some good rules of thumb, if you will. I think the first one is making sure that the person that you're hiring has your best interest in mind. In our industry, we call that being a fiduciary. I think that is important. I think the second thing to really consider is when we think about fees, or we think about paying somebody to help us and give advice, there is a cost to what a good financial planner does for their clients. There's a lot of value in what we do for clients. There's a lot of psychology that we employ when working with folks to keep them on track, to help manage their emotions. We know markets go up and down. We know life happens, and we try to help people, make good, clear, rational, thoughtful decisions. And there's a cost to that. But the flip side of that is we don't want necessarily to have, investment performance dragged down by fees or internal expenses and things along those lines. So, working with somebody who has that approach, looking for, thinking through that whole part of it as you're making decisions, I think is very, very important. At our firm, we have 4 advisors on our team. Everybody kind of fills a role on that team. One of our team members is a certified financial planner, a CFP for short. And as a firm, we probably have somewhere in the ballpark of around 60 or 65 years of total combined experience between everybody on the team. So there's a wealth of knowledge and understanding about markets and market cycles and investments and all of those components that help people be successful. All of that being said, there are plenty of other advisor teams out there that do a lot of the same things that we do. I think it's really important to find people that you feel get you and your family and are going to advocate for you, and not just looking for a commission or something along those lines.
Yeah, and correct me if I'm wrong, but you have a vested interest to make sure that your clients' investments grow. You have a vested interest in that.
That's correct. Yeah.
Whereas there are some firms out there that they'll take their pay no matter what's going on with the portfolio, if you will. Am I wrong in that?
I think that the vast majority of people in our industry want to see their clients succeed. However, we also believe very strongly in incentives and relationships, and we want to be on the same side of the table as our clients. As they grow and benefit, we obviously grow and benefit in that as well. That's our approach. That's the way that's philosophically where we come from.
Well, thank you, Rob, for joining me today. And I'm going to go ahead and include Rob's contact information in the upper screen here. And if anybody needs Rob Young or his team at Blue Dot Wealth Management for any sort of financial planning, Rob and his team do great work, as I mentioned before, and I'd be happy to connect you with them if you want to reach out to me, or if you want to contact Rob with the contact information on the screen. Thank you for taking your time, Rob. I really appreciate it.
Oh, hey, you're really welcome, Jonathan. Thank you for the opportunity.
Thank you for watching. Please like this video and subscribe to our channel so that you can stay up to date on our future content.